So this is actually my second time recording this because I went through the entire video thinking I recorded it only to realize that I never hit the record button. What's up everyone, Dane the Mortgage Guy here with another 3-minute Thursday video just for you. Now, in other videos, I've talked about debt to income ratios and what they are or what they need to be, and I'm going to break that down for you today and explain to you how to calculate your debt to income ratio and give you guys a couple good rule of thumbs on where your debt to income ratio should be. Now, before we jump into that video, let me do the normal. There's the clock. There's all my information up here. Disclosures are down south. And here's the company that I work for, which by the way is an amazing company. Shameless plug. And let's get to it. 3-minute Thursdays start now. So, debt to income ratio, what is it? It is how much money you are bringing in versus how much money you are sending out. Okay, so there's two different types of debt to income ratios. There's going to be your front end debt to income ratio, which is just your mortgage payment, which is your principal, your interest, your taxes, your insurance, HOAs, mortgage insurance if you have it, all of those in one payment, right? And that's going to be divided by how much you make a month. Okay, now if you don't know exactly how much you make a month or you need a simple way to calculate it, I will put that information somewhere towards the end of this video, and you'll be able to then calculate how much you make a month. As for back-end debt to income ratio, that is taking your monthly mortgage payment that you have, adding on any debts that you have, minimum payments on your debts, and that creates your back-end debt to income ratio. Now, what debts count against your back-end ratio? Credit cards, loans of any sort, student loans, car loans, personal loans. If you've got a vacation home, that loan counts against your debt to income ratio, child support, alimony, anything that is going to potentially show up on your credit report. Now, things such as your utilities, cell phone bill, your Netflix subscription and your subscription to Hulu, HBO, and all the other streaming services, those don't count against your debt to income ratio, so you don't have to worry about that. Now, before we jump any further, your debt to income ratio is based off of your gross income per month, meaning how much money you make before taxes, before Social Security, before all the other things that are getting taken out of your paycheck. So how do we calculate debt to income ratio? So in order to calculate your debt to income ratio, let's make this easy. Let's just assume you make $10,000 a month, okay? You don't want to spend more than $2,500 on your monthly mortgage. When you take that $2,500, you divide that by your $10,000 that you make a month, that gives you a 25% debt to income ratio. That is your front end ratio. Now, once you've taken all the debts that you have, and like I said, they are minimum payments only, you tack that onto your monthly mortgage payment of $2,500, you divide that number by 10,000, and that becomes your back end debt to income ratio. Time. Did I get it? I'm pretty sure I nailed this under 3 minutes. Now, before we go much further, a good rule of thumb is that 50% of your monthly income is the max debt to income ratio on the back end that you're gonna wanna go. Now, every program, whether you go FHA, conventional, VA, USDA, they're all gonna have their specific guidelines, and there isn't like a golden rule or a golden debt to income ratio that everybody has to fall under. Now, I tell my clients to try and stay under 50% because that's gonna give you a little bit of breathing room, because you may have heard the term, don't be house poor. You don't wanna spend all of your money a month trying to survive, and you can't even pay for anything else like food and going out and activities and Hulu and Netflix and all those things. You need to be able to pay those too. Like I said, every single program is going to have a specific debt to income ratio, and it is up to your loan officer to explain to you where your debt income ratio needs to be in order for you to be able to qualify for whatever program it is that you are wanting to get. Now, earlier I said I was going to give you guys a couple of ways to calculate how much you make per month to be able to calculate your debt to income ratio, and that's what I'm gonna do now. So if you are an hourly employee, take your hourly wage, right? So let's say you make $30 an hour and multiply that by 2,080. Now, where are we coming up with this 2,080 number? Well, there are 40 hours in a work week, and there are 52 weeks a year, and when you multiply the two together, you come up with 2,080. So we take $30 an hour, multiply that by 2,080, and then we're gonna divide that number by 12 because there's 12 months in a year. Now, another quick tip coming from my old recruiter days, to basically just take your hourly and multiply that by 2 and add a couple zeros to it, and that's essentially pretty close to what you would make per year on an hourly wage. So if you make 30 bucks an hour, that's essentially 60,000 a year. If you make 25 an hour, that's essentially $50,000 a year. If you want a more accurate number, obviously multiply that by 2008. Now, if you have a yearly salary, that number is actually really easy to calculate because all you have to do is just take your yearly salary, so whether that's, let's just say it's $65,000, and you divide that by 12 because there's 12 months in a year. So that's debt to income ratio for you. It's actually really simple and not anything that should scare you away. Yes, us mortgage loan officers and lenders and originators, we do use a lot of acronyms, and trust me, even me being in the business, there are still a lot of acronyms that'll be like, what? I don't get it. I don't know what that means, because everybody makes up their own acronyms. But a very common one is going to be that debt to income ratio, or DTI ratio. And this is just what we talked about in this video. As always, thank you so much for watching these videos, hitting that subscribe button, hitting that like button, sharing it with all of your friends and families. If you know anybody that is looking to purchase a home or even refinance their home and they have questions, send them over to my channel. I'm sure I'd be able to answer a lot of their questions in some of the videos that I posted. If not, I would love to talk to them as well and figure out if I can answer their questions and do whatever it is that they need to have done. If you haven't done so, please do follow me on social media at Dane.the.mortgage.guy on Instagram, Facebook, and YouTube primarily. And also check me out on my website at DaneTheMortgageGuy.com, or if you want to go shorter, DTMG.me. I love you all. Thank you so much for hanging out and watching this video. Hopefully I answered your questions about debt to income ratios, and if you have any more, leave them in the comments and I'll get to them in the next video. Love you all. Cheers. Stay safe. I will see you guys in the next video.